Hi, everyone, and welcome back to the AI Interconnect Podcast, where we sit down with founders and operators shaping the future of PropTech, real estate, AI, and everything touching the built world. And today I'm joined by someone who has spent the last 7 years building and scaling a unique property operation model across Canada. And Jason Duncan, co-founder and EVP of RenPerks. Jason built RenPerks across 44 locations, covering 6 regional boundaries without marketing spend or acquisition. He captured data across markets, built behavioral systems for tenants, and managed growth during some of the most challenging regulatory years in Canada real estate. He is now preparing for a major pivot, restructuring the entire model and launching a new global platform on January 1st. The transition is hinted at during our pre-call. And Jason, welcome to the show. Very happy to have you here.
Thanks very much, Laurent. I appreciate you inviting me to be here. It's, as you pointed out, some very exciting times, and you happen to capture us at a very unique point where we're coming out of a period of looking reflectively at everything that we'd accomplished over our first 6 years of scaling our business and looking at what the horizon not only looks like, but where we see some significant burdens or challenges in operating models, trying to find some new ways to approach and getting over those to develop a truly scalable model.
Yeah, that's definitely a very, very critical but very interesting time, an excited time. You mentioned it to me at our pre-call many, many times. And okay, let's start with your personal story. What pulled you into PropTech in the first place, and what was the original insight that led to building RenPerks?
Thank you for that. I'd always had a fascination in real estate. When I was a child, my mother was a school board in Toronto principal, and at the time, the pension fund was creating the idea around using pension money to create what became one of Canada's largest REITs. And 3 of the 4 principals in the Toronto School Board that pitched the pension fund the idea of that were friends of my mother's. So at a very early age, background story of where things kind of culminated was growing inside me. I ended up after university in the technology space, and I was a part of things like startupweekend.org and a lot of lean methodology applications. We'd sit every Tuesday and Thursday morning at 7 and some developer shop in Toronto and talk about how to bootstrap and launch companies with no capital for one, but being able to develop scale where it wasn't just our friends and family using an app and it works. We're talking millions of instances happening simultaneously and being able to manage things like load factoring and all sorts of other aspects. I digress. I was in a hosted services business at the time. I saw what Amazon Web Service was doing, the AWS model, sort of a writing on the wall, call it. And at the time, we were deciding to make an exit from the business. And over the course of one summer, a university friend of mine had been back to Toronto, and we got to catch up at a couple of weddings. Tall tale buddy story. I ended up seduced into the idea of commercial real estate. Again, always having an interest behind the curtain of real estate. And I saw an opportunity to develop equity by getting into a market, which I'm in now, which is Calgary, Alberta. It's an energy-centric industry, despite what people say about the changes. It's still predominantly energy-driven. And that also makes our markets ebb and flow. So from a capital standpoint, the opportunities are, as an economy goes up and down, I saw it as an opportunity landscape for me, and I relocated out here. I spent about 8 years in commercial real estate. Predominantly, my book of business was land assembly, design build. So I'd work from site acquisition all the way through to overseeing construction and project management and things as well. Got into some really interesting projects, but along the way, I randomly met a guy in a coffee shop, which is apparently something that I do quite frequently, by the way. But we ended up running into each other again and finding out we lived across the street from one another. We started to develop some rapport. And he was talking to me about an idea that he had. And at the time, I was in commercial real estate. I really wasn't interested in the residential component at all. I saw it as a lot higher workload just because of the client base and things, to the transaction value. But at one point, we were out, we were having a couple drinks and chatting, and the light bulb went on where I realized there was a way to take the concept of that model and apply it in the same way my managed infrastructure company ran, or hosting. You think of a monthly subscription, we all know. Well, if I can just keep adding clients and they're paying a monthly subscription, there's scalability in that. And that's when I started to develop the interest in joining on. And we spent about a year and a half road mapping everything out. And then we ran an RFP and we sent it out globally, and we shortlisted when we instructed them that we were going to come to the development offices and audit the capability of building an enterprise platform. You'd appreciate very quickly the audience went to crickets, and only a few responded because they may be a guy on a couch trying to build a big company. Who knows? But we ended up flying around the world, 3 different countries, auditing the offices, and we shortlisted a couple, ran that through the final touches of the RFP, and then decided to hire a group. And at the time, they were out of Bangalore in India, HP and Infosys developers, and we thought we had some pretty good team. The project manager had some really good questions when we were laying everything out. So we had a level of confidence, at least to begin at that stage. And they went and built it over the course of a year. So I was still doing corporate real estate at the time, managing my transaction volume while building the business in the background. And then, as a cost of doing business, because we were becoming a property management entity, I relicensed myself to become a managing broker. I did licensing in multiple regions. This was a barrier to entry cost rather than hiring personnel, as you might appreciate in a startup. And so as of December 1st of 2017, my license officially had to flip and become what we called rental miles at the time. And we launched, but it wasn't quite working. So we had to fix a few things. And we ran until about April of 2018 before we actually started taking on properties in our management model. I digress. Over the course of that time, obviously we weren't generating income. Things were burning, trying to build map up. And we were originally launching as a model to acquire property managers and do an aggregation play over single family rentals throughout North America, because the market here has a 30% adoption for property management. Essentially, 70% are self-managing investors. The bulk of them hold 1 to 10 assets. Sorry, on average, they hold 1 to 10 assets, and the bulk of them own 3 to 5. And so there's a real disaggregated marketplace going on in the background. And so part of our strategy was to acquire property managers and drop some respective pins on the map, and then double down by branding in the local marketplace to create conversion and hopefully tap into a segment of the market that didn't exist for property management, by first and foremost giving a client base a platform that they could have assets in any location, and not just held with a property manager, but held with a platform model that they could see everything in one portal and be able to access all their documents and focus on their jobs, which most of them typically have, or investment strategies and trying to grow those respective portfolios. So we were doing that. We were talking to a couple of opportunities around some venture capital, and there was far too much being pushed on the table for change in the model and exit story and everything else that falls into the venture capital space. And we decided to go it alone and control the model the way that we wanted it to operate. And so I began negotiating those regional expansions you mentioned, where I would either go to an existing property manager, or a lot of instances a realtor that was just kind of serving some basic property management needs of find a tenant, which we call FAT. They're just doing bodies into boxes and they're not collecting the rents. So they're outside the regulatory requirements for property management. And we started picking up a few portfolios and we launched in Calgary, where I reside. The barrier to entry is easier while I'm here. We then expanded to Vancouver, where my partner had recently moved and sort of had a little bit of bodies on the ground. And then it started to get more interesting because in our first year, we had rebranded to RentPerks. Part of the reason was we launched under a partnership with a reward company called Air Miles in Canada. They were bid against Aeroplan at the time, and the terms ended up being a little better with Air Miles on paper. But in our first year, we just found that it was incredibly unproductive of a partnership and was not really bringing any value add to what we were trying to do. We had advertisement to even things like in a grocery store, the little checkout bar between your food. We had all the brand placement and all sorts of things going on that really didn't do anything to impact our revenue at all, unfortunately. And so we stepped away from that relationship for a couple of reasons. And we realized what we needed to do was build our own reward company because the rewards were challenging. And the biggest problem in rewards is the redemption side. You got penalties and restrictions, and it's very onerous for somebody to hold rewards. This is in 2018. So at the time, IFRS 15 requirements, accounting principles globally, requirement for all reward value was to hold a dollar equivalent in account for conversion. And so what that meant was at the time there was $16.5 billion of unspent rewards globally. And so we were launching a part of a strategy to go in and convert those rewards onto our reward company. And we got seduced by all the storytelling, and we went down the path of building a cryptocurrency, launching an ICO, which is an initial coin offering that was going on at the time. We had managed to position ourselves globally as a top 3 out of the top 5 rating for trust prior to launch because our value traded at 4 cents US, which is equivalent to reward spend dollars, and 300 reward partners in our ecosystem for redemption. I was doing a lot of great things. And at the time, we were talking about third-party marketing as a reward company. In Canada, we have an airline called Swoop that I was discussing about potentially building them a reward company. My partner had been talking to Kaiser Permanente, which most people know in North America, insurance and medical and all sorts of things. And they were creating a reward model around healthy behaviors that could be monetized. And this all comes back to why a reward company? What does that have to do with property management? Well, RentPerks, rental miles, the concept underlying the entire model was incentive-based behavior. And to develop true incentive-based behavior, you need to tap into things that can actually be impacted. And in property management, the 2 biggest challenges that we saw facing investors of real estate are on-time payments and damage to property. And so our model was to create a valuation, an analytics model that specifically looks at the way that you're taking care of property and integrating that analytics around our property inspections as an example. So it spits out a rating on how well you take care of a property that you rent from RentPerks. And then that mirrors your payment consistencies. But, it has to go further than just a nominal gesture. And where you mentioned in the introduction, we were able to capture some really unique data, having gone across the 44 locations. And I can tell you, I was in portfolios of real estate that I probably would not want to walk past myself in person. The reality is that they were sold as a good story and a package deal to us in a number of instances by the real estate investor world who are using other people's money to buy real estate. It just ends up being a lack of capital to run CapEx and OpEx properly. And so those assets, they just end up being debit machines and being passed over, and somebody else will go and do it. They don't capitalize properly, and they'll never get the return value that they would if they were properly capitalized, which a lot of us tend to realize. And so we started to look at our client base, and over the last 2 years made a bit of a shift away from some of the single family and the investor model, and going after more builders and developers, putting up density, and giving us the opportunity with some small scale at a building instance to do some really unique things around the marketing. Coming back to the incentive modeling again, some things tie in on that as well, but implementing things like QR technology, text technology off of infield signage, land and private marketed websites, the whole application process right there at the push of a button while you're standing in front of a property that's being completed. And so we've got some interesting things there as well. But to go back on the poorly performing assets, we have data that proves that even in the worst circumstance, we can improve on-time payments. And it's through the incentive modeling. And so as an example, when rents are late, the first thing that a tenant would get is a notification on how many rewards they missed out on. And there's tiered structure in that over a couple of days. And what we were able to see is that messaging and automation and everything that went on was actually able to facilitate on-time payments. And so what I'm having conversations about right now with portfolio real estate developers is what a 2% delinquency actually costs to a significantly sized portfolio as a value proposition financially. And so, you think about the way that we expanded, it was great. I did that mostly myself by negotiation. Yes. There were a couple acquisitions from property managers where I arranged some vendor finance, and because of our operating model, unique cost and profitability perspectives would allow us to get out of portfolios with zero capital in some instances, just because of the terms we negotiated and what we're able to make off of a existing portfolio that wasn't running through a lot of advanced modeling like our platform does, as an example. But I digress. We scaled across, as you mentioned, 44 locations. This was over 6 provinces in Canada. So we were essentially coast to coast. We were in Nova Scotia, New Brunswick. There's not much further than that. And then British Columbia and Vancouver and in the island. So we were at other odds of the spectrum. And, for a lot of your viewer base, the importance there is the significance around all of the legal regulation variations between region. And it's funny because my partner and I, we always joke, in Canada, we've got 13 driver's licenses, but we all drive on the same side of the road, stop at stop signs, pretty much obey all the same laws. But we have to have a license in each jurisdiction. And our demographic is not comparable to the UK as a small island in the ocean, right? So where we early on started to see a lot of our roadblocks to scale is the constant auditing and reporting and mechanisms and things that you have to take on under a regulated environment and have to do with the hold of funds and everything else, which was fine. We built a fintech component where we have an integrated merchant facility with our banking partner, which is currently TD. And essentially all of our payments went directly into trust and then disposed from that trust account out to respective parties, whether it's us or vendors or ownerships, etc. And all of that was, a pretty interesting line of code, as you'd appreciate. Banking is still on mainframe technology at a commercial level. So we're going back 2 decades to basic communication layers. And on their spreadsheet of columns by rows, they have a total of 41 of each. And in some instances, we ended up using every one. So quite a complex financial environment to our platform as well. But even in that space and holding funds and doing all of these things, there's still a lot of challenges around the management of the capital and properly planning assets. And at the end of the day, our challenge in North America, we've seen, is consistent across a number of regions. We've done a lot of data research on markets of the US that we were planning to expand. And on our website, we had 7 locations throughout the United States that we were negotiating expansion into through a unique partnership. And that ended up at a roadblock situation with our US banking partner, Wells Fargo. We had the code all developed. We were about to go live, and the risk department stepped in and said, hold on a second, we've never seen anything like this. And they wanted to unpack the whole situation. Well, as you can appreciate, when you've got a deal in hand like this, time kills deals, and those ones ended up not working out. I'm optimistic that there's a silver lining in that, and we may have avoided some additional challenges that I'd already mentioned in building our portfolios across Canada and shifting our model into a little bit more portfolio management than independent landlords, as an example. Excuse me. But I digress. We had a portfolio that was looking really good. Personally, I was very excited about the portfolio in Hawaii, that we could find ways to make fruitful business operations, etc. But that ended up fizzling out. And through that year, we were really looking reflectively at the existing portfolio and wanting to make changes. And we stepped away from some large portfolios that, as I mentioned, just assets that you really don't want to touch, especially as a business that's trying to make an impact in the market. When you're trying to make an impact and there's no capital to impact at all, you end up being blamed for the problems without the reality that you just have really poor underperforming assets and there's nothing you can do to improve them. Despite the fact that we could improve on-time payments, it's not going to change the long-term revenue model financially without proper investment. And so we saw that consistency, and that was part of our shift away from the single family space to go after more portfolio and building management. So we spent that year taking my commercial real estate background and looking at pro forma based real estate valuations properly with depreciation and everything that people don't factor in, and building a model that we could assist financial planning for acquisition strategies and using the existing revenue to lever those situations more specifically. And so I went into my dream pipeline of what I want, and I want the portal to provide me this and that and the other thing, laid this all out, and then we looked at ways we could build it, and then we spent about 8 months tweaking our model to create a new owner portal that wasn't just about your individual assets, but if you had portfolios of buildings as an example, well, now you're able to open your portal and you can see real-time data on how your asset is performing within the portfolio, which means, asset A versus asset Z are performing completely different. And as a percentage of what the expectations are, the values that you enter into the system, and it gives people real direct insight and a creative way to look at, acquisitions and dispositions of real estate and stepping a little closer into the facilitation of trade management over those assets, as an example. But I digress. Over the last while, we're really building this all out. And I got to June of last year, and I started to see some really unique things that I would suggest regulation was used as leverage to advantage personal financial situations. And I won't go into the detail, but we realized that there's a lot of challenges in regulation where things just aren't dealt with correctly, and they're definitely not dealt with in a timely fashion, as we all know. And so our biggest challenges in regulation isn't about what we are required to do in order to facilitate that. It's the backlog of the support around the framework itself. And in a lot of instances, self-regulation across industry as well. So from Canada's perspective, we have a number of regions that, while we have regulators, it's self-regulation that performs. And the fact that it's self-regulated means that they want to maintain control first. And so there's a lot of things that happen in the framework that are principally about maintaining that control. And then you've got examples where it's blown up in the face of self-regulation in places like Ontario that recently had the registrar themselves directly involved in some nefarious activity, which undermines respect and control across the entire framework and impacts everybody else that's a part of that ecosystem who had absolutely nothing to do with it. But it's just bad. And in BC, they've sort of stepped away from the self-regulation into a little bit more of a administrative level of government, which has its upsides and downsides, with everything. But we look through the framework of everything that we're actually required to do, and why it was important to us as a business. And we realized that a lot of it wasn't things that we saw an ability to, I wouldn't say effectively manage, because that's not true. It's just, it's very burdensome operationally. There's a high cost to it. And the high cost to facilitating the basic expectations and the outcome is a real hard sell when you're talking about negotiable fees and things like that with these respective owners. And I would argue part of the problem in the single family market in North America as to why people don't use property management is they look at cost first. They don't look at it as an investment. And the unfortunate thing is, I think the regulation and the way that we have to do things does have an impact in that. And I'll point out a data point that we're really looking at right now, which is in North America, property management currently has a 70% turnover annually. You can't employ people. People don't want this job anymore. Regulation is literally killing its own industry, and people are just hard pressed to find a gig. And so what ends up happening is you find younger and newer people that don't have any capacity or wherewithal to manage some of the specific situations that a property management licensed entity would. And you have to train them, which is a high cost, and you get them out in the field, and they're sold on the idea of being involved in real estate, but within 8 to 9 months, they couldn't care less about real estate, and they're never going to work in it again. They're left, they're gone. And we're looking at that as a real pain point. And how do we find ways to facilitate getting the outcome in the service delivery and stabilization of the revenue models and everything else without having to fall under the regulatory framework? And so from July, I started really drilling down into all the things that I'm faced with as a broker, and things that I could do that don't require me to be a broker, as an example, and building out a new framework and model around that. And so we have made the decision to wind down RentPerks, and we are going to pivot the entire operating model into an unregulated space where it is a platform as a service model with the a la carte aspects of things that you may want to have done, and really looking specifically in the regulatory framework of how those things can be provisioned out without falling into the perception of being a property manager. And so I'm very excited after a couple of years of long and daunting challenges of what do we do next, and where are we going to have an impact, because even at our scale and what we did, that's not big enough to have an impact. And even when I go to investors and I talk about what we're doing now with a target of 250,000 units within 5 years, that is conservatively less than 2% market share. While it has a really big target number and revenue model about it, from an impact standpoint, it's really inconsequential. And so somebody asked me a really unique question just a couple of weeks ago, like trying to drill into me, like, why? Like, why are you doing all of this? And it probably goes back to my involvement as president of student council when I was in university, and we found unspent revenue from previous years, and I worked with the administration, and we devised a plan where we got the money matched by the university. Then we had the government match that amount, and then we held the gala fundraiser, raised money to match that, and then what we ended up doing was securing an endowment that funds scholarships annually, so that people that can't afford to go to school and get an education can actually go and do that. And when I first moved to Calgary, I didn't have any family here, so I volunteered more. I was, helping in Calgary at something called the Drop-In Center over the holidays. I worked with United Way doing an all-in for youth program that was a re-engagement of education for high school dropouts and things like that. And so it sort of caught me almost like a deer in headlights when he drilled down to get to the question. And I realized, I think my long-term objective is to build something that has representative value, that we can actually be a voice and create some change. Because None of us are ever big enough, independent and standing alone and trying to make a change. We are forced to accept things. And despite surveys and feedback that we often are invited into in providing, it's not a singular voice. It's disaggregated. And I don't think the information's reviewed in the best of ways. And maybe people are afraid to maybe call out and point things out because they think that they're actually being tracked through surveys and everything else as well. So we sit on our hands and we don't say things. And that's not my style. I'd prefer to find a way to build something and create a momentum from it and hopefully find more people to join in and become a part of what we're doing so that we can positively impact everyone that we're involved with and hopefully beyond us as well.
Okay, I love it. This is great. You work across many regions, and you talk with operator in Brussels and Poland, part of Asia, North America. What similarity? Because I want you to zoom out a little bit. What similarity do you see us across market, or what problem repeat themselves everywhere?
Great question. I think first and foremost, I'd probably draw attention to where I end up being connected to people, which is arguably the thing that interests me, is that people are really trying to change something that they see as broken. And it may be directly related to what we're doing in a business model standpoint, or it could be related. And you mentioned Brussels, that one in particular. Johan Steins, professor at the university, is commercializing a technology that will allow us to scan a building and be able to break apart the materials within a wall, as an example. And his objective is to reduce the carbon footprint by tearing the whole wall apart to find the problem and being able to isolate and cut in and repair and move on. Where you think of the hundreds of thousands of apartment units that we have throughout the world, that right there is a massive reduction in carbon. And I've actually, excuse me, prior to shifting our new model, one of the things that I was really adamant about was looking at ways that we could track carbon reduction in our model as well. Where we were interested in looking is by tracking vehicular travel from service delivery for things like showing a property to creating inspections on the property or managing vendors and being able to lay a geofence scheduling framework over top of our map and suggesting that option A, we can reduce vehicular travel by X, and option B and option C as an example, and then doing things like a carbon buyback where we can create an incentive to choose option A for our residents in the properties, and they get a little token gesture of additional rewards that can be funded by the carbon reduction that we achieve by that metric as well. So I think because I'm thinking about it at that scale and having significant impact, I'm finding my reach globally is increasing, but my circle becoming significantly smaller, if you understand what I mean. And so the problems that we're facing are arguably property management is the oldest industry in history. Some people argue that. I still think the cave came first. And so what we're doing in the industry is advancing the ways that we do it tremendously. And I don't want to discredit where we are in the call it PropTech space. Is we're doing amazing things. But how often are we stepping back and looking at what we're doing and asking ourselves, is there another way to do it? And I think in the conversations that I've started having in the last year, far more interesting, far more significant in representative impact in a marketplace and engaging in a way that is not just a nice introduction and I like what you're doing and thank you very much. And we move on and keep talking endlessly to people. It's an introduction to an idea that we can compartmentalize or we can break apart and we can find things in it ourselves and do aspects where we're essentially all working together at the end of the day. And I think the challenges are consistent. the problems really in this industry are about the way that we are able to manage personnel. I'll give you an example. In North America, this is the metric we built RentPerks off of, or rental miles. We looked at property management as a cost. And so the first cost we have is a salary base, and they're going to cost anywhere from 80 to 120,000 a year, call it. But for a traditional model property management business, they have to be 100 to 140 of unit leases in a year for them to make the profit to afford the salary of that person. So starting on day one, we're at odds with one another. And what ends up happening in a traditional model is they burden the personnel with workload to try and offset the cost of the salary base. But it's not effective because those things that you burden them with take them away from what they should be focused on, which ultimately is customer service. And so we began our model by looking at that and how to break apart all the tasks that are required to facilitate a service delivery of competent property management services. And what we found, most of the things that property managers are doing have nothing to do with regulation. I'll repeat that. Most of the things that property managers are doing have nothing to do with regulation. They're just other things they're doing as a part of their job to facilitate what they're actually licensed to do. But where the license comes in is very specific and almost siloed. And it goes back to that cost of how do we manage the cost. So the biggest thing that I see, and consistent across a lot of the software, we launched this company and came into this space knowing there were 100 software platforms out there for property management. We're just another one. What are we doing? No, you have to look at where the consistencies lie and where some of the new things people are trying to do have a timeline, and are they short or are they long? And looking at ones that will actually measure some level of an impact, and then you have to factor in the cost. But I think the biggest challenge, especially in developing software, as you'd appreciate, Laurent, you talk to a lot of people, and they want to fix a problem, and they fixate on the problem, and they build around that one problem, but their thinking can be siloed in a lot of instances and miss out on the residual impacts that one focus is actually tapping into, and a lot of times indirectly, but it still has an impact. And so how do you have conversations around, what are you not talking to me about? What's really going on? And what are you just accepting as the norm because everyone else accepts it as the norm? That's the stuff I'm really fascinated by, because I hate norm. I don't like complacency. And we started building our model by really trying to offload things that could be automated, and the people that we employ to focus on the good parts of the business, and thereby the customer service level elevate, because they can respond and they can spend time, they can interact, because they're not just shoving bodies into a box and moving on to the next property. It's changing that. And we even did that from a monetization standpoint, where the remuneration was broken apart by levels of effort and impact over the stabilization of revenue versus just paying you to put a body into the box, which a lot of traditional models still do today, which I think is an ethical flaw, because now you're monetizing people to place a tenant, maybe not put the level of care into the diligence of the type of tenant that's being placed. And then you end up with all the financial challenges of that bad tenant, as an example. I found some interesting data on single family in North America, targeting that 70% of self-managing investors, where the first thing that on average a self-managing investor will do is negotiate against themselves. They think they've got a good tenant, they're concerned about the revenue, obviously, and they're going to negotiate. And on average, they'll lose US 1 to 3,000 in annual revenue. The second one is the one that nobody understands until it hurts them financially and emotionally is the placement of a bad tenant risk. And on average, that's 3 to 8,000, just on average. We know the significant ones that go way beyond that, obviously, but the average is 3 to 8,000. So you're already over 10,000 annually at risk just stepping into the equation yourself. And then the third one is, I'll be honest with you, I think a lot of property managers don't even understand this one, which is structural vacancy. And we just assume that the owner will pay the debts. But if you're not educating them that they have to pay the debts when there's no occupancy and they get into a financial situation and they're not prepared, well, then that motivates them back into the first cycle of just find a tenant and put them in the box. I got to get my debts off my back. And so that cycle of those three events is consistent across the entire industry. And I think that's the largest impact on why single family sales in North America trade on average every 7 years. They just end up in a situation and, husbands and wives at the dinner table killing each other, getting into divorce over real estate investments that they thought they were going to retire from. And it's not what it sounded like when they got into it. And they just continually trade. And I think, unfortunately, is the 30% of the industry in the property management that participate in sales predicate themselves a bit on that as well. Not intentionally, but see an opportunity that they can represent the trades. And so they end up doing property management and sales. And now they're at a conflict with every realtor in the marketplace as well. The answer, the problems are all the same because the business is the same as it always has been for 100 years. And nobody's thinking about it differently. That's the real problem. So we're trying to take different approaches. And I'm trying to think about ways that we're not looking at it. And I try as best possible to talk to people that are from other areas of the industry and get their input, because vendors will have a lot of conversations with people like us that are doing different things and they've got feedback and perspective, but how many people ask them what their perspective is?
Yeah.
So
Jason, you talk about regulation, killer operation burdens, and your story, your transition. I think I'd love to hear what you're putting together by January 1st, and your new vision. But I thank you a lot for what you tell us today. And then definitely I want to hear your vision for the new model going forward. There will be another episodes
love to.
of this. I thank you. Thank you so much.
I think I'll have a few of the factoring put together that I'll be able to answer a little bit more Q&A over that one as we get a little closer to the new year. But yeah, so far I had a meeting this week. We broke through, late last week. We broke through a bunch of different things, and it looks like there may actually be a silver lining in it all, and there's a way through it that we can actually step away and build something that can scale a little further. So I'd be more than happy to share that with you. And we're all very, very happy to have been invited to the podcast today, and very excited to see what your audience and your membership has to say. And for anybody in that as well, I'm not the type of guy that likes to hold my cards too close to a degree. I'm an open, sharing person, and I'm happy to entertain conversations and bounce ideas off of. So if I can extend that to your network as well, I'm more than happy to do that. And I thank you once again, and I look forward to our next conversation.
That's great. I know many listeners will relate to the challenges you faced and the reinvention you're stepping into. That's great. I really enjoy. I had many questions, but you answered everything. You answered all my questions, and in order, unbelievable. And that's why it was my pleasure to hear what you had to say. And thank you so much for being here today.
I really appreciate that, Laurent. Thanks very much for your time. You have a great day.
That's great. That's great. And that's it for today's episode of AI Interconnect. And if you enjoy it, share it with someone who is building the future or someone who should be. And until next time, stay curious, stay creative, and keep building. Thank you, Jason.
Thank you.
Hold on, stay with me.